Hey everyone, Rob B here with Rob D, and you are listening to the Property Podcast. Now it's market update, so we're giving you all the latest info on property prices. And spoiler alert, the info is conflicting. We of course discuss mortgages because they have been all over the place the last few months. And we finally unearthed a member of parliament who likes landlords.
Welcome to the Property Podcast. Thank you for joining us for the show where we take time out from advising a multi-million-pound property fund and arranging hundreds of deals a year for our clients and bring you the knowledge that we've gained along the way for free. Staying on top of the news is so important for investors, so do make sure you subscribe to the show, whether that's on Apple Podcasts, Spotify, or wherever else you listen, and get yourself signed up for our weekly newsletter, Property Pulse. It's completely free, and it ensures that every Friday, the biggest news stories that you need to know about come to you. It's a super quick and easy read and makes sure that you're effortlessly up to date. So sign up for that one at propertyhub.net/pulse.
So much good stuff coming up in this week's episode. But before we get there, we've got loads coming up in the magazine to tell you about as well. Because we have the latest magazine going out, and the focus of the latest magazine is niche strategies. We're looking at the more unique ways you can invest in property and look at case studies of people who've gone and done property a little bit differently. And we've also focused on Nottingham as a location. We've done a deep dive into Nottingham. So if you've ever invested there or want to invest there in the future, then that article is going to be a must. Plus plenty more. We're looking at tax changes, global property market update. There's loads. So magazine subscribers, lucky old you. You are going to get this in the post very soon. But for those who aren't magazine subscribers, what are you doing? You listen to this, but you don't get that magazine. And it's so cheap as well. £5 for a copy, £6 a year. What an absolute bargain. Well, let's put that right if you don't subscribe. Go to propertyhub.net/magazine and get yourself signed up. And not only will you get all the issues through the post every other month, but you will be able to access digitally the back issues as well. And there's loads and loads and loads of content at your fingertips there. It's an absolute steal. So if you're serious about property investment, you should be a Property Hub magazine subscriber. Go to propertyhub.net/magazine.
And also, just before we get into this week's news, we have entered the British Bank Awards for Portfolio in the Best Investment Provider category. Super cool that we've got something that we can enter for the British Bank Awards. I love that. Now, this category is voted for by the public. So if you're excited about what we're doing with Portfolio, maybe you even invested in our crowdfunding and you want to help us out a little bit, then you can really help us out by going and voting for us in that category. It'll only take you a few seconds, and you'll find the link for where to do that in the show notes for this episode.
So we cannot have a market update and not start with property prices because everyone wants to know what's going on. And according to the FT, UK house prices have fallen for the 5th consecutive month. And that makes it the longest decline since the 08-09 financial crisis. 5 months doesn't seem like a lot, but that's kind of the run we've been on since 08, that we haven't had a run for that long. So nowhere near those levels of 08-09, but as you've just heard, the biggest in a long time. So prices dropped by 0.6% between December and January, and that's according to mortgage provider Nationwide. But taking it month by month doesn't tell us too much. So the 5-month run is interesting. But what's also interesting is it's still up over the last 12 months. So even with 5 months of drops, it's still up by 1.1% since January last year. So 1.1% is nothing to get excited about. But if you bought a property 12 months ago, you've not done too bad. You're still up by 1%. Now, this isn't any surprise if you've listened to what we've talked about on the podcast with our predictions and looking at the market and our expectations for the year. A lot of this information and data is lagging, and something I've stuck my neck on the line and said is that I believe that the property market will look its worst until Q1 this year. Now, that absolutely can be used to your advantage if you believe, like I do, that the second half of the year will be better, because you want to do your deals when sentiment is weakest, especially if you believe that things aren't all that bad. And Rob, if you look at Rightmove, then you could maybe jump to that conclusion that things aren't that bad, because a bit of surprising data coming from the latest Rightmove press release.
Yeah, interesting one this. Data from Rightmove shows that asking prices increased in January. So they had been falling as well, but then asking prices rose in January. And I always find Rightmove data really interesting because this is a leading indicator. So you've got the actual prices of sales that were agreed. That lags quite significantly. Then you've got the data from the point at which mortgages were agreed. which is the nationwide data we were just talking about. But that's not perfect because about a third of property purchases don't use mortgages at all, so they don't appear in that data. Then you've got Rightmove's data, which is a leading indicator. So this can tell you on the demand side what people are looking at, how many people are booking viewings. And then on the supply side, it can tell you how many properties are being listed and how much they're asking. So by putting all these different data sources together, you can build up a better picture of what's actually going on. And this, I think, Rob, is going to be a very interesting one to keep an eye on, because asking prices have gone up, but all right, that doesn't mean they're actually going to achieve those prices. So this is what we're going to need to establish over the coming months. Are sellers becoming more optimistic and buyers are going to be willing to pay those prices? Or is this just irrational New Year's optimism and those properties are going to be reduced in price and ultimately asking prices are going to fall again? Too early to say now, but a really interesting one to track because it paints quite a different picture from some of the other data that's out there.
Another really interesting report that's come out, it's come out from HomeTrack. Now, we often reference HomeTrack for the cities index that we quite regularly quote and talk about, and we use that report to benchmark against for our prediction to assess the cities we've picked and how they do across the year. But they've put out another report, which is a general UK house price index. So this is looking at the UK as a whole, not just the cities. And this is really interesting. So nationwide are showing property prices are up 1.1% over the last 12 months. But HomeTrack suggests that prices are still up 6.5% over the last 12 months. So they have shown declines recently, like all other indexes, but their data shows them that it's not quite as bad as, say, nationwide. Doesn't mean that either of them are wrong. It's just the data sets that they are choosing to use. But that's not the part that's interesting to me. What's interesting to me is some of the takeaways that they've added here. So first of all, demand has rebounded to pre-pandemic levels. So the market is in line with 2018 and actually 10% higher than 2019. So it feels like demand is slow and the market's really just ticking along. But what's actually taking place here is that the market is just behaving as normal. And we've said that on the podcast before, but not many people are getting that. Is that this is a normal market. It's not a boom market. It's not a bust market. It's just a normal market. But there is negative sentiment, and you can use that to your advantage. And yes, we told you last week that Rob and I have made our first investments of the year already. Fast start for us, we've got going, and that's because of that negative sentiment and our belief that things are going to improve and that we're not in a crash, and all the data is pointing towards that we are not in a crash. Normal market behaviour just feels different to where we were last year when we were in the start of a boom phase. Something else is really interesting though, Rob, and you'll be very happy to read this because you made the prediction this year that flats would do better than houses when it comes to capital growth. And HomeTrack have also made a similar prediction. And I'll quote what it says. It says, early buyers are focusing on flats with a shift away from houses in response to the higher borrowing costs and the hit to buying power. So, Rob, it's only February. Your prediction isn't quite nailed yet, but it's always nice to see others agreeing with your point of view.
It's a nice start. I'm not sure I completely agree with the reason they've given, though. That may be part of it. But I think another one is just general patterns of demand. We've clearly seen the peak in terms of everyone trying to escape to the countryside, and we're seeing some degree of moving back again, and city centres are becoming a lot more popular. So just basic supply and demand tells you that that's likely what's going to happen. And I think, Rob, that's an important point to end this section about house prices on. Well, there's probably two things to say about it. One is, over the long term, none of this really matters. Whether the market this year ends up being up a bit, down a bit more, over 10, 20 years, makes no difference at all, but it is fun to speculate about what's going to happen, which is why we do it. And the other point is that this is all talking about averages, and depending on the type of property you buy and the area you buy it in, you can end up doing far better or far worse than the average. And what I was effectively saying with that prediction and what HomeTrack's data is saying now is that whatever the market on average does, if you're buying big houses in rural areas, you'll probably do worse than the average. And if you're buying flats in city centres, you'll probably do better. So I think seeing beyond the average is an important point to focus on for this year, because there's always variations, but I think those variations are going to be exaggerated this year, which again creates opportunity. I've just made my first investment of the year, and of course I've done it through our own service, Property Hub Invest. Why do I do it? Well, because it completely takes all the effort out. I don't have to go to any viewings, don't have to do any negotiation. I've got someone to help me get through all the legals and liaise with my mortgage broker, and it secures me a great discount. If you want to find out if Property Hub Invest is right for you, well, good news there as well, because the way to do that involves having a completely free strategy meeting where even if it turns out that it's not right for you, you're still going to come away with loads of useful information and insights. So to learn more and book in that strategy meeting, just go to propertyhub.net/invest.
So moving on now to base rates. And normally base rates make big news. And you may have even missed that we had a base rate increase in the last couple of weeks. But it didn't really get much headlines. And that's because what happened was expected. So the Bank of England had done a good job of letting everybody know, the markets know, that it was going to move from 3.5% to 4%. And that's exactly what happened. And when everyone expects something, it's not really newsworthy. So there wasn't a lot of coverage around this story. But that's a good thing, because there was so much chaos towards the end of last year. It sent the mortgage market into disarray. And we ended up with ridiculous rates and ridiculous margins on those rates because lenders were nervous. And then lenders eventually took advantage of that nervousness and were taking higher margins than normal. Now, when you have certainty, you have a settled market. And the Bank of England are making pretty much everyone aware also that they expect interest rates to top out at 4.5%. So we just jumped 0.5% from 3.5 to 4%. But they're letting the market know that it's only got 0.5% more to go. So when that happens during this year, it's not quite known yet, but we're nearly at the peak. But according to the noises coming out from the Bank of England and the general market's belief that we are nearly at the peak. Some are saying that we won't even reach 4.5%. And all of this, Rob, means good news for mortgages or people who want to take out mortgages.
Yep, another big theme of this year is mortgage rates falling. And that might sound strange, like, well, mortgage rates falling when interest rates are going up. But it's like you said a minute ago about expectations. When you're looking at fixed rates, it's all about future expectations. And at the moment, what's happening with the path of rates is exactly what was expected. And actually, if you go back to what was expected in the last quarter of last year, rates are remaining significantly lower, which is why rates are coming down. And there's plenty of scope as well for them to come down further, because at the moment, the margins that they're charging on those loans are much higher than they have been in recent years. What we're starting to see is a bit of a price war. Now, it's obviously not the same kind of price war that we had when you could borrow at like 2% or something. We're not going to get back down there again for a very, very, very long time. But we are starting to see a price war with lenders reducing their margins because there is less demand in the market than there was a year ago. Therefore, there are fewer mortgages to dish out, but lenders make their money by writing mortgages. So now the market's more settled. They are competing with each other to attract borrowers. And in just the last couple of weeks, some big players, including Santander and Barclays, have reduced their rates. Where they go, lots of the others will follow. So we're reporting on this story now, but Rob, I think we'll be reporting on a variation of this story next month and the month after that as well, at least.
Yeah, there's so much happening in the mortgage market right now that we obviously will keep you up to date, and we bring you special episodes on the mortgage market quite frequently as well. And it won't be too long before we give you another full mortgage market update. Because let's face it, it's a critical component of anyone's investment strategy. So you need to know what's happening. Whether you're looking to get a mortgage now, in the future, remortgage, get your first buy to let, most of us will take a mortgage. So we'll keep you updated. But we must also keep you updated on the rental market, because rents continue to climb, according to a press release from Rightmove. And there's some interesting data here. What's interesting is that rents in Q4 continue to go up, quarterly change of 0.9%, which was an increase, but not as dramatic as the quarter before. So rents are continuing to go up, but not at the pace they were. But wow, what a pace it was going at. Even though it's slowed down, the annual change means that rents outside of London went up by 9.7%. And the average rent outside of London now is £1,172 per calendar month. But it may be slowing down, but there still is an imbalance between supply and demand. And while there are more properties coming to the market than previously, there are also more people inquiring about rental properties as well. So that imbalance is still present, and that suggests that rents will continue to rise for the foreseeable future. Maybe not at the pace they were, but it'll still go up. What's interesting, though, is the national average is up, but Greater London, the annual change is up 15.7%. So London's rents have gone through the roof. Absolutely crazy growth in London. But property prices, as we've regularly reported on, haven't moved much at all over the last few years and continue to not be doing anything of note. And that's why we keep saying that we're keeping an eye on London, because if rents keep going up, which they are, and prices don't follow, which they're not, then at some point the yields become attractive again. They're not there yet, but they may be in the future. So we will, of course, keep you updated on our strategy, what we're looking at. And when I say our strategy, it's not just for us personally, it's for Property Hub Invest and Portfolio as well. We'll, of course, keep you updated of any changes to those strategies. But for now, London is definitely one to watch, especially with data like that.
I'm now going to say something that hasn't been said on this podcast for a very, very long time. Good news for listeners in Scotland. But it's good news from a very low base, because the news is, congratulations, you can now increase your rents again, but only by 3%. So since last September or so, from memory, the Scottish Government passed a law that meant private landlords couldn't increase rents at all for existing tenants. You still could for new tenancies, but not for existing tenants. That legislation is due to come to an end. And when we reported on this last month, it seemed like they were going to continue with the freeze for another 6 months. But they've relented somewhat, and now they're going to keep the ability to control rents, but they're allowing rents to rise by up to 3%. Still, though, on the whole, pretty poor. And in, I'm sure, Rob, a completely unrelated news story, The Telegraph has the headline, "Why Scottish Landlords Are Buying Up English Property at a Record Rate." And there's a pretty stunning chart in there that shows that the proportion of Scottish investors buying outside Scotland has pretty much doubled in the last year alone. So while the government has now been nice enough to allow you to raise your rents a little bit, still way below inflation though, I don't think that's going to be enough to stop that trend from continuing.
And finally, Rob, there's a bit of shock. I think shock is the right word, because we have an MP that is defending private landlords. So wait there, there's somebody in power not attacking landlords. This has to be newsworthy.
Yeah, I'm sure he'll be pushed out of his job soon because something has gone very wrong. It's a Conservative MP, Andrew Lewer, who's written a piece for politicshome.com, and it reads just like a very balanced, sensible article about what's going on in the market. It quotes lots of the same sort of data that we've been quoting over recent months. Maybe he's a listener, who knows? And the core message of what he's saying is basically you need a private rented sector. More supply is needed, so you need to firstly build more, and secondly get out of this pattern of just punishing landlords in every way you can think of. And he talks about the tax system in particular, including stamp duty, and of course all the changes that George Osborne made back in 2016. So we'll link to the full article in the show notes. It's just one MP. I doubt any of this is going to be taken very seriously, but the fact that there's even one MP saying anything positive about landlords at all, well, that's progress, isn't it?
So it's time for Hub Extra, the part of the show where we give you a little bit more. And this week we have a resource that you're probably all familiar with, but some of you may be reluctant to use, because I certainly was. I was one of these people who just didn't get on board with this. And what am I talking about? I'm talking about the Apple Watch. So I was lucky enough to get an Apple Watch at Christmas, and I'd long held off wanting one because I had this belief that I didn't want to get disturbed. I didn't want a phone on my wrist. I'm addicted to my phone as it is. I have to work hard to make sure that I don't spend too much time on my phone. And I didn't need another thing to try and distract me. But I got it all wrong. I really did. The Apple Watch is not a phone on your wrist. Yes, it can make calls. And yes, you can look at your emails if you want to. But you don't have to. You can take all that stuff off, at least the emails part anyway. What the Apple Watch does really, really well is it gamifies the process of getting fit. So Apple have rings, and you have to close your rings each and every day. So make sure you close your rings, everyone, if you get an Apple Watch. And you become quite addicted to that process. It measures different things, from how much you stand up each day to how many calories you're burning and how much exercise you are doing, and it will move those goals for you depending on how you're getting on. So if you do quite well, it then moves it up, and I'm pleased to say that Apple has moved the goalposts for me. I'm less pleased to say that I don't hit it every day now, so I have to work a bit harder, but that is the point. It gamifies the process of being active, and I think anything that does that is something that's worth sharing and talking about. So the Apple Watch is brilliant for that, but I'm going to give you an extra resource because really does start to get you focused on your health and well-being. And a big part of that is sleep. So I was also considering getting the app Whoop, which measures your sleep amongst other things, but really focuses on sleep. And your Apple Watch does do that. And the data it gives you is okay. It's reasonably good. But I've gone and got myself an app called Athletic. It's spelled differently. So it's ATHLYTIC. And it costs around 20 something pounds a year. But the data it takes from your watch, it puts into interesting charts, but it helps you measure your recovery from the day before, so you know what level you can perform at today if you're going to do exercise, exertion levels, your sleep, which is what I've kind of been getting a bit obsessed with recently, and your energy levels. For 20 odd pounds, it's a brilliant upgrade, and I highly recommend that. If you get the Apple Watch, you might want to check that app out as well. So if you haven't got one of these watches, you may be a little bit skeptical. But if you do want to improve your health and well-being, I do believe that an Apple Watch can help you take a step forward in the right direction. So maybe don't be as skeptical. Check it out. You can tell I'm a fan, and you might become a fan too if you get one.
Well, we've got this long-established pattern with Apple products where you tell me about something, I ignore you, then a year later go, why didn't you tell me about this? It's amazing. And so I'm sure I'll be the same with the Apple Watch. Not tempted yet, but give it a year. We'll see.
When will you learn, Rob? When will you learn?
Well, hopefully you, listening, have learned that listening to the Property Podcast is a worthwhile use of 20 minutes or so, even less if you sped us up. So hopefully you'll join us again next week. In the meantime, you can share your opinion on anything we talked about today on all the socials. We're Property Hub UK, and learn about Portfolio at portfolio.co.uk. So have a great week, and we'll see you soon. Bye-bye.
Bye-bye.